Hi, everyone. Thank you so much for joining us. We're really excited to be here today and to present these new webinars to you. And just a little bit of background, these webinars are part of the breakdown of our webinar, 7 Pillars for a Successful Sales Tax Strategy. We've broken down each pillar into separate webinars, and we're doing them a little bit out of order, but right now we're going to do registrations, and next up we're going to do returns. So let's go over some housekeeping things and then we can get started. So first of all, if you're here for CPE credit, you will need to answer the poll questions as they pop up on your screen. If you move your mouse around a little bit, or if you have double screen, sometimes they're on that second one. But again, you do have to answer those poll questions in order to receive CPE credit. You will also need to fill out the survey at the end of this webinar. It should pop up for you automatically as you are exiting. It will also be emailed to you in 24 hours. A couple other things to take note of here. If you have questions as we are going along, please reach out and ask those questions. We would love to hear from you. We'd love to answer your questions. You can use the Q&A button in the middle of your screen. Wiggle that mouse around, you'll see it. If we don't get to your question, we will follow up with you via email. So thank you for your questions. We appreciate it again, and please use that Q&A button. We also will be sending out the slides after the webinar, or not after. Once we get the ball rolling here a little bit, I will send a link to the slides. They are also uploaded directly to Zoom and will be emailed to you. So you will have access to them and you will have multiple ways to get your hands on them. And a few other things to take note of. Oh, actually, let's do some introductions. So first of all, sales tax and more. All right. So I'll go over the other slide, the mystery slide here. Sorry, I guess we're a little rusty, but we do have these webinars pre-recorded and CPE is available as you, I totally forgot about the slide. You can get CPE on your own time. We are now offering pre-recorded webinars. You can get that through our Salt Vault or through the webinars directly. If you're just interested in only the webinars, please reach out to me and I will help you get that set up. And you can also see more information about it at this web address here. And again, a little list of what's included. So I will do better next time to going over this, but that's a little bit of a snippet of that. So quick introduction for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, and really, like our name states, more. So if you have questions about our services or would like to work with us, please reach out. We would love to hear from you and we'd love to work with you. And a quick introduction to our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded and he has helped thousands of companies of all sizes and in all industries, and is especially well-known for his work in the e-commerce industry. And with that, I will turn it over to Mike and be back for the polls. It's all you, Mike.
Thank you very much, Ellie. Great introduction. And just want to let everyone know we're having some storms here, so I get bandwidth problems if things get garbled. I do apologize. All right, so we've got a lot of information to go over today, and people think, well, registrations, how tough can they be? And they're not as easy as most of you may be thinking, or some of you may be thinking. We're seeing more and more problems as they relate to registrations, people getting registered for the wrong type of registration. So that's why we want to have this webinar. Today, we're going to cover some common questions as they relate to registrations. We're going to go over the different ways to register. We're going to look at determining past liability. We're going to take a look at the mitigation programs like VDAs, amnesties. We're going to touch on filing frequencies. Then we're going to talk about retail delivery fees and income tax. Right now, a number of the states are increasing as soon as you get sales tax, they're including an income tax registration with that. And we're going to go into that in a little bit more detail. We're going to try to debunk some myths and then open it up to questions. So we get started with one of those polling questions Ellie talked about.
Yeah, that question should be up on everyone's screen right now. We really want to get a feel for who's in the crowd today. And these first couple questions are centered around Nexus specifically, but really we want to know about your sales tax knowledge and registration knowledge as well. So your answers here are: what's Nexus? You know the basics, you have an intermediary knowledge, or you are an expert. And most people are falling somewhere in the middle here, but some are absolute beginners and some are an expert. So why don't we close this out and move forward?
Okay, thank you very much, Ellie. And as always, we want to remind all of you that the worst time to find out that you have problems is when the state's contacting you or that your clients have problems. And the reason why is that there are programs out there where you can mitigate past exposure, but a number of voluntary disclosure agreement, they're only available if you're proactive. Once the state contacts you, and it can be by mail, it can be telephone call or email, and the states keep, by the way, a lot of times people say, well, they called me like 2 years ago. They're not going to remember that. Oh, yeah, they will. We've had people get kicked out of VDAs before because they did not disclose that information to us. And most states keep fairly good records. So, and for every rule, there's an exception. A state like Michigan, even though they've contacted you, will still let you go into a program like a voluntary disclosure agreement. But in most instances, any of those mitigation programs are off the table. So you want to be proactive rather than reactive. Now, here are some of the most common questions we get. When and where should we register? How should we register? Once registered, how often do we file? And what are some of the you have to look out for? So we're going to try to answer all of these questions today. And by the way, before I forget, registrations are tough. And in that salt vault that Ellie, there are step-by-step PDFs and screenshots of how you should register if you're registering with, because you have an economic nexus. The confusion comes in. So if you need a walkthrough, they are part of that salt vault. Every state out there. All right. So what should sellers do? Well, sellers should register whenever there is nexus. Their potential exposure is material. What they sell is taxable, and the marketplace is not currently collecting. So we've gone over, taxability. We've gone over nexus in other webinars. Those are some of the other 7 pillars. Today, I just want to talk about materiality because that's my comment. That's not the states. Most states believe you should register from dollar number 1. I think we need to use some common sense. And, especially, in states that have transaction thresholds, maybe you're selling a $5 item and 200 transactions, that's $1,000 in revenue. If we look at an 8% tax rate, that's about $80 in tax. And I don't think that just because a state says you should do something, that we need to blindly follow the state. I mean, I think we need to use common sense. And if the cost of compliance needs the back tax plus penalty and interest, does it make sense to file? And in the example I was just using, I would say, no, it doesn't make sense, because even if you're doing this on your own, it takes time to get it done. And once you register, then you have to worry about filing the return. In some of these states, you're going to be a monthly filer to begin with. So you got to take all of that into consideration. So $80, even, if the state adds 100% of that to penalty and interest, which they're not going to, usually it's somewhere around 50%, but let's say 100%. Well, on a $1,000 worth of sales, your exposure is going to be somewhere around $160 then. I don't know of anywhere where you can get the, registration done and then filing done for $160 a year. So even if you're doing it on your own, the time is money, and you could be doing something else with your time rather than this. So I'm a big believer in getting registered if your exposure is material. If it's not material, then I say let the state come and find you. Now, everyone's next, well, Mike, what's material? And I can't answer that for you. Use the Coca-Cola example. I mean, Coca-Cola, $100,000 is a rounding error, but to me, $100,000 is a lot of money. And for each one of you or each one of your clients, what's material is going to be slightly different. Now, I can tell you what I don't believe is material because I can't ever make the math work. So if you've got taxable sales of less than $3,000 a year, I just can't ever make the math work. In fact, it's hard to make the math work below $5,000 a year. So I can tell you what I don't believe is material, but I can't tell you what is material. You got to determine that for yourself or help your clients work their way through it. Things that we say you need to look at. One is risk tolerance. I mean, we have some people who call us and can't sleep at night. They hear footsteps. And, if this is you or one of your clients, then maybe you do get registered at $3,001. But we have other people who tell us, Mike, I go to Vegas every week and I never lose. And nothing bad has ever happened to me in my life. And I don't think that the state is going to find me. And, if that's your attitude, personal threshold, because, you're still sleeping at night. Second is profit margins. We are working with some companies that are working on extremely low profit margins. They tell me, Mike, I need to build up my market share. So I'm working at a 2% margin. And unfortunately, this is a different conversation, but as soon as you raise your prices, you're going to lose all that market share. So not always the best way to do things. When it comes to sales tax exposure, your average sales tax rate is going to be around 8%. And then, if we look at that 50% penalties and interest on top of that, 50% of 8% is 4, two together. So for every $1,000 in sales you have, you've got about 12% exposure. And if you've got states don't always find you this afternoon. They may find you 3 or 4 years from now, 5 years from now. And if your profit margins are only 2%, not only, 4 years down the road, not only have you wiped out all your profits in this one state, you may have put yourself out of business. And to make matters worse, some states talk to each other. States, and you're not going to get 50 states following up, but you may have another 2 or 3 states follow up within the next 6 months after the first state finds you. So if you've got a 50% profit margin, 100% profit margin, you can afford to take some bigger personal thresholds. And I keep saying personal thresholds because that's what they are. Your personal threshold. This is what you believe makes sense in order to get this registered. And So profit margin is very, very important. The third thing is capital reserves. So if you have a lot of money in the bank, and it's not going to impact your business if a state does find you, you can have a higher personal threshold. So I'll tell you what, most of our clients that used to be registered between $5,000 and $20,000, 99% of them. But that has changed. And what we're seeing now is we're seeing most of them being registered somewhere between $7,000 and $12,000. So that has changed over time. That's what they are believing is material to them. All right, so you've determined that you have nexus, or your clients have nexus. Your potential exposure you've determined is material. Your sales are taxable, and you're selling outside of the marketplace. So what should you do next? Well, we have what we recommend is a three-step process. So number one, you determine where there is a need to register. So if you have nexus, and nexus simply means link or connection with the state. If you have nexus, what your exposure is material and what taxable, and you have a responsibility to file, then the second step is to quantify the past liability. So we're assuming that step number one is already taken care of. And the responsibility to file, you only sell on marketplaces, and the marketplace is responsible for filing. Marketplaces are like Amazon. So that's what responsibility to file is about. Number two, you have to quantify the past liability. And once you know what your past liability is, then you can determine the best path forward. Do you want to register prospectively? Do you want to register historically? Do you want to do one of the liability mitigation programs, like a voluntary disclosure agreement, an amnesty, or a managed audit? So lots of ways to register. Now we're going to go into each one of these in a minute here. So I do want to say registering prospectively, everyone wants to just register going forward. They don't want to worry about that past exposure. That's getting tougher and tougher to do because a lot of states, historically, states didn't check up on you generally. States, especially Illinois and Wisconsin right now, they're letting you register, but coming back 2-3 years later, auditing everybody to see if they got registered with the correct date their nexus began. So registering historic with or without a penalty waiver request, and then again through these exposure mitigation options. So how do you quantify past liability? Well, there's a couple of ways. If you just want a quick, rough estimate, that's what I was using earlier here. We use a 12% number. And the reason how we get to that 12% number is we use an average tax rate of 8%. And then we use 50% for a mix of penalty and interest. So 50% of the 8% is 4%. Add those together and you got 12%. So you first have to determine the first date of nexus for each state. And then you're going to determine the sales by state since that first day of nexus, and then multiply it by that 12%. It's not meant to be an exact number. It's just meant to be a ballpark figure to help you decide get registered going forward. The second thing, if you want to be more accurate, and we're doing more and more of these right now, is to do an and that can be with or without the VDA cost benefit analysis. Most of the times it's all combined together. The first two steps are going to be exactly the same. You got to determine the first date of nexus, determine the sales by state since that first date of nexus. But then you're going to try to determine the actual tax penalty. And the first step in doing that is to get the rates that were applicable at that time. Then you're going to multiply the sales per year by the actual rates. And that's going to give you, a number that if the state finds you, here's what they're going to be asking you for. And it's hard to get interest correctly. So even though we're using the exact interest rates, each state looks at the calculation of interest a little bit differently. So these, again, are not going to be to the penalty, but they're going to get you very close. Then you want to multiply the actual rates. You want to look at the VDA look back periods. And we're going to get into a little bit deeper, but they're usually somewhere between 36 months and 4 years plus the current year. And redo the numbers using the VDA benefits and compare them to as if the state found you. And why we're doing this is let's look at what we do. This is an actual example of a data review that we do for our clients. We look at the data for the last 2 years and make recommendations based upon that. So you can look at this, if you don't have exposure going back, a lot of years, if you're just, starting to cross thresholds, this is one of the ways that you can determine when and where you should be getting registered. So this is just for example purposes. If you're interested in us having doing something like this for you, let us know. This here is a little bit more detailed, and generally we ask for the last 7 years worth of sales, because we want to know what your potential exposure is if the state found you. And then we're going to, calculate if the state finds you, how much money would be due to the state. So you can tell, okay, if I only owe, down to South Carolina there, if I only owe $848, that's not too high up on my radar. These are sorted, by the way, not in alphabetical order, but by the amount of potential exposure. And that actually is not the way this one's done. But generally, that's the way we do it. So you got to figure out somehow what your potential exposure is before you go out and get registered. Because once you're registered, again, now the state knows about you, and a lot of mitigation options are off the table. So the second half of this is, the VDA benefits, the cost benefit analysis. Does a VDA make sense? And this is really, really important. There's a software company out there that pretty much says if you owe more than $500, then you have to do you really should do a VDA. You don't have to do it. And by the way, we charge, and I'm talking about the software company, $3,500 for a VDA. So why in the world would you pay anybody $3,500 to submit $500 worth of tax for you? It's ludicrous. I looked at, one of these reviews by Avalara yesterday, and to me, it's almost criminal. Number one, they recommended their practical approach. They said the state wants you to do 28 VDAs and 1 registration. Our practical approach, we think that you only have to do 19 VDAs and 9 registrations. And I looked at this, and they're not even telling anybody, if you do a VDA, how much money are you going to have to pay the state? Because when you do a VDA, you still have to pay all of the back tax within that period. You get penalty waived, and in a handful of states, you get interest waived. So why, again, a VDA is a great tool, but it's not a one-size-fits-all tool. You got to know what your potential exposure is before you say, yes, I want to do a VDA. Otherwise, we've seen companies that do this, and they may owe $30,000 in taxes, and Avalara is sending them a bill for $100,000 prior to even paying $1 of tax. So that's one of the issues. But the other, even if the VDAs make sense, you got to know, do you have the ability to lay out all of this money all at one time? Some companies don't. They got to do this 5 states at a time, because the exposure can be huge the last 5 years. Avalara is slanting the numbers. They're only telling you what the exposure is for the last 12 months, and that's way it's just smoke and mirrors, misdirection. It's allowing their salespeople to manipulate you. So basic rule of thumb is, you got to, before you say yes to a VDA, you got to know what your potential money that you're going to pay in through the VDA is. And number 2, here's our golden rule. You got to be saving at least as much money by doing a VDA as the VDA is going to cost you. And we're going to touch on this more throughout the presentation. So, Ellie, you want to go to the next poll question?
Yes, absolutely. I am launching that right now. A little bit of a quiz for you here. So what is not a way to register? Your choices are register through an amnesty, register through a VDA, register prospectively, or register through telepathy. It should be register telepathically, I suppose. But give everyone a few more seconds. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. So my answers are still filtering in. So let's give everyone a couple more seconds, and then you can tell them if they were correct or not. So let's close this out and we can move forward.
Everyone, this is a smart group. Everyone got this question right. All right. So here's our first myth that we want to bust. You have to register with the Secretary of State when registering for sales tax. And this is an absolute myth. You do not. As a matter of fact, when you're registering just because of an economic nexus, I don't know of a state out there where you have to do this. But now, when you go to the registration, nowadays most people register, through the online systems that each state has. They make it look like you may have to register with the Secretary of State, but there's a workaround, or you answer the questions correctly and you will not have to register with the Secretary of State. Now let's talk about prospective registrations. And very simply, this just means that you're registering with a current date or future date. And maybe that's what you should be doing. Maybe you're about to cross a nexus threshold, or maybe you just crossed a nexus threshold, or maybe you just hired an employee in the state or opened a warehouse in the state. Maybe you just created this physical nexus. So that is when prospective registrations are supposed to be used. If you have previous nexus exposure, then the states want you to utilize one of the other registration methods. Now, many companies just want to stop the bleeding, okay? Because once you get registered, then, the penalty and interest clock stops ticking on the period in which you're registered, not prior periods, just from the point you registered going forward. So many companies, they just want to stop the bleeding and they want to take their chances with a prospective registration. They know that the state can come back and get them for those past periods, but at least they're not continuing to accrue any liability. And the longer you go without the state finding you, the less likely it is for them to find you. Because most companies, one of the ways that they're found is through the audit of someone else. And audit periods, usually 3 or 4 years. So after you get 3 or 4 years without being found in someone's audit, the chances are never going to be zero that you're found, but they get lower and lower with each passing day. So a lot of people doing prospective registrations. Now, as I mentioned earlier, some states are cracking down, like Illinois and Wisconsin. We don't allow any of our any of our clients to do prospective registrations in those states, because it's not a matter of if the state is going to find out, it's a matter of when the state contacts you. So here's some of the issues. Not the way the states want it done. If there is past exposure, the past exposure is not going away. Here's some of the aggressive states out there. Illinois, Wisconsin are absolutely the most aggressive. South Dakota, they question registrations, and you can lie to them, if they call you up and ask you, but generally when a state's asking me point blank, I think that raises things to a whole nother level if we're lying to them. Accidentally putting the wrong date down on a form is one thing, but when you're being questioned outright, then you generally want to answer truthfully. We expect more states to be getting aggressive. So, while a lot of companies are doing this right now, this window is going to be closing within whatever period of time it is. I think more and more states will start acting like Illinois and Wisconsin. Now, historic registration, that's when you use the actual date that your nexus began. And this is one of the methods the states want you to use if you do have past exposure. Now, the states are going to want back returns, and you've got to generally be responsible for the back tax, the penalty, and the interest. You always want to request a penalty waiver, and most of the time the states are going to work with you and grant those penalty waivers. Waiver of interest almost never happens. We always ask for it just in case, but in general, you're never going to get a waiver of interest, especially on a historic registration. Sometimes a state, for the older periods, instead of making you do, if it's a monthly state, instead of doing 12 monthly back returns, they'll allow you to do an annual return for the older periods, and then for the current periods, make you do whatever the filing frequency is going to be. So those are the two ways when we talk about registrations, most people think about it. We haven't gotten to how you register through the mitigation options yet. We're going to do that. Filing frequencies, a lot of people say, well, I'll just file annually. I'll set it up so I can do that. And very few states allow you to choose your own filing frequency. Most states are either going to, set your frequency up by statute. Georgia, they say that for the first 6 months, everyone is automatically going to be a monthly filer, and then we'll look at what your sales are and determine if you're going to stay a monthly filer or go to a quarterly filing or semi-annual or annual. Some states look at your estimated sales. Now, someone says, well, I'll just estimate that I'm going to have $1 sales. Well, you don't really want to be putting red flags out there. So you want to be fairly accurate. At $2,000, you'll have roughly 50%, if that's what your monthly sales are, 24,000 a year. And most of the states are going to be looking for monthly figures if they're asking. That's going to be roughly 50% monthly and 50% quarterly. After a certain period of time, so even if you manipulate your filing frequencies in the beginning, once the states start seeing the actual numbers, they're going to come in and change them. And they change them throughout the year. So they'll either to say that you now have to file monthly, or actually you may have to prepay. There's a whole bunch of different ways that states can do this. If your sales aren't that high, they can change it going backwards. So you don't get to choose this. And by the way, annual filing frequency, some states say if you're filing more than $80 of tax a year, you can't be annual. You have to be filing less than $80 worth of tax a year in order to be an annual filer. I say, well, why in the world are we even registering then? Does that make sense? Let's talk about the materiality. $80 worth of tax, is that actually material? So filing frequencies, we've got to, know that the states have control of this rather than ourselves in most instances. All right, so here are some common registration mistakes. One is registering for a sales tax versus a seller's use tax. Sometimes that seller's use tax is called a retailer's use tax or a vendor's use tax, or vice versa. Maybe you get registered for a use tax when you should be getting registered for a sales tax. And it makes a difference as to what rates you collect and as to what forms you file when you're filing your secretary. Registering with the secretaries of state, I mean, when you register with the Secretary of State, a lot of times you now have an income tax responsibility. And if you're just have economic nexus, there's no reason to get registered with the secretaries of state. Entering the wrong start date. And I'm not talking about whether you're choosing a prospective or historic registration here. There's a trick question. And the states ask you, when did you start doing business in the state? And a lot of people say, well, I've been selling in the state for 4 years now. So they put down a date 4 years ago, and the state's going to come back and say, thank you very much. Now give us the last 4 years worth of back taxes, penalty, and interest. What the state is actually asking is, when you started doing business, is when did your nexus begin? So make sure that you understand the questions that you're answering when you're doing registrations. And then turning on the tax collection. We're seeing a lot more of this. Some companies forget to register, or they think someone else in the company is doing the registration. So now they're collecting all this tax and they're not registered. They don't have the right to collect the tax, and they have no way to remit the tax. And that leads to tax collected, not remitted, which is the cardinal sin of sales tax. Then we've got registering through the Streamlined sales tax program. And a lot of people ask us this question. Before you do that, you got to know who's going to be doing your returns, because not everybody can use that type of registration. We don't use it. Only the big software companies can utilize that program. There's a lot less visibility. You can't really see into your account and see what's going on, or someone like us can't do it. So there's a lot of problems, we believe, with that Streamlined program. All right, so examples of registration created problems. We talked about registering for the wrong types of tax. Well, we're seeing this in Illinois a lot right now. Prior to Wayfair, you would register for the retailer's use tax, and you only had to collect the state level tax at that point. You didn't have to collect any local taxes. Well, on January 1st, 2021, Illinois said, okay, if you have an economic nexus, no other connection with the state, you now have to collect the retailer's occupation tax, and it's got to be destination based. So if you were already registered, then you had to change your type of registration. If you weren't registered yet, when you get registered going forward, you got to make sure whoever's registering you knows what the new rules are, because Illinois is very, very aggressive, and they're going back after companies for not collecting the right amount of taxes, the local taxes. All right, a second example here. And there was a software company out there, for whatever reason, they could not file the Oklahoma vendors use tax form. I just don't know why. And because of that, they told everyone to go out and just register for software. It's no big deal. Well, it is a big deal. You register for the vendor's use tax, which is what you're supposed to be registering for as a remote seller. Number one, there's no fee that you pay to the Department of Revenue or Treasury, whatever they call it in Oklahoma. You don't have to get registered with the Secretary of State. You don't need a registered agent. There is no income tax requirement automatically. But as soon as I go to register for the sales tax, I got to pay the Department of Treasury or Revenue, whatever it's called, $25. Then I got to go and get registered with the Secretary of State. I got to pay a $350 fee. I've got to pay for the registered agent, and that has to be renewed every year. And I'm subject to their income tax. So registering for the wrong types of tax can have problems, and they can really add up. These are just two examples. I could go on and on, but we do have limited time. All right. So if a state fines you, in theory, they can go back to the date that you first started doing business in the state. That is when your nexus began. In practice, they don't, if you've been doing business there 20 years, they don't go back that far. They routinely, though, go back 7 to 10 years, depending on the state. Could they go back 20 years? Yeah, I've seen states try to do it. We've had companies come to us and say, hey, the state's going back 12 years. It was state of Texas, and normally they only go back 7 years. So they can go back longer than that, but they generally limit themselves 7 to 10 years. Now, the state's going to want the back taxes plus the penalty and interest for the entire period in question. And penalty and interest can quickly exceed 50% of the tax owed. And once the state finds you, these mitigation programs that we're going to be talking about are either limited or disallowed. So one of the best programs out there, we started talking about this when it comes to mitigation programs, is a voluntary disclosure agreement. And as a reward for stepping forward voluntarily, states are generally going to limit that look back period. So most of the states are 3 to 4 years. Some of them will say 3 plus the current year, 4 plus the current year. So if you're in January or February, it's closer to 3 years or 4 years. And if you're in November or December, it's closer to 5 years. Virtually all of the states that do have a VDA program waive the penalty. And in a handful of states like Texas, they'll waive some or all of the interest. Texas actually waives 100% of the interest. Oklahoma waives 50% of the interest. So this can be a great tool. In California, the look back period is 8 years. So if you enter into a voluntary disclosure agreement, right away, you're knocking 5 years of back tax, penalty, and interest off the board. So, and you also get the 10% penalty waived for the 3 years where you do have to pay the tax and the interest. So some exceptions to that 3 to 4 years: Hawaii, Nevada, and Iowa. New Mexico does not have a VDA, but they do have a managed audit program. So VDA generally not available. We say generally because, there's the odd state out there that'll still allow you to do it once the state has contacted you. And this is, what I was talking about earlier. VDA can be a great tool, but like all tools, it's not for all scenarios. Our rule of thumb is you want to save at least as much as the cost of the VDA. You also want to know how much money you're going to have to give a state. I mean, if it's, I'm going to go back to the Avalara again. And they're saying, oh, for the last 12 months, and it was counting this year, and it was as of March. So those numbers are even skewed. They're not even using last year's numbers. So they're, you know, they give the impression that you're going to owe this much money. But no, I mean, what happens if it's a state like Washington, which is 4 years plus the current year? You'd have to multiply that number by 5 almost in certain circumstances. And if all of a sudden, you're through the process, you're already disclosed, and then you figure out you can't pay, that's a problem. Now, they do offer payment plans, but generally you don't want to enter into a VDA or don't want to disclose who you are until you have a good idea of how much money this is going to cost you. And some people, come from Avalara, doing 40 VDAs and then find out, oh, in order to get the benefits of the VDAs, I got to pay, $3 million in back taxes or whatever that number is. So you got to know, number one, what your exposure is. And it's for people with a lot of exposure. I mean, if you have very little exposure, don't do a VDA, do a historic registration. All right. So, by the way, a VDA is usually done anonymously. Someone like us, someone like Avalara goes to the state and says, hey, we have someone who wants to get compliant, and here's their fact pattern, and we want to enter into the agreement. They'll send out an agreement, and you fill the conditions and pay your money, and then they'll waive the penalty. That's the overall general process there. Now, in some states, they're going to try to include income tax in that VDA, unless it's prohibited by Public Law 86-272, or you're exempt for some other reasons. So in some states, if you want the income tax to be included, you actually have to request it, but a lot of states automatically put it in there. All right, so an amnesty, they're generally not true amnesties. You still have to pay the back tax. People hear the word amnesty and they get all worked up and say, hey, we got to take advantage of this amnesty. Usually a VDA is better than the amnesty. And the reason being is there's no limitation on look back periods in general when it comes to an amnesty. Now, again, every once in a while, Washington about 10 years ago had an amnesty with a limited look back period. And we said, hey, skip the VDA, go straight to the amnesty. But amnesties are few and far between, and they're short durations. They're 30 to 90 days. And, a state may offer an amnesty once every 10 years, once every 3 years. So you don't know when the next amnesty is coming. Penalty can be waived. Some or all of the interest is generally waived. So amnesties are more generous with penalty and interest, but it's that look back period. How long have you had exposure? How long is this program for? Once in a blue moon, a true amnesty is available. So right now, Tennessee has an amnesty for sales tax until 1 year after they become a full member of the Streamlined Sales and Use Tax Agreement. And that is a true amnesty for sales tax, not use tax, not any other type of taxes, but for tax, sales tax. So amnesties sound great, but the VDA is usually the better option in most instances. Now, if you've already been contacted by the state, maybe the amnesty is better. But in most instances, the VDA is going to be better. Amnesties are less formal than VDAs. So another instance it may be good is you can't, justify a VDA on the basis of the cost. But since an amnesty requires less paperwork, then maybe you can justify the amnesty over the VDA. All right, so a managed audit is performed by a third party like us, or you can do it on your own. The audit is actually supervised by the state, so we can't just, go willy-nilly and say, okay, we're going to do everything in the best interest of our clients. I mean, we always keep that in mind. But what's the sense of doing something and having the state override us? So we want to work with the state. Now, as a reward for the state not having to do all of the work, state's generally going to allow for a penalty and some or all of the interest waived. California has a really good managed audit program. If you can't get into a VDA, then you can get registered, request a managed audit. Again, there's no limitation on the look back period. But if you have years of past exposure, that interest adds up quickly, and that can be waived, at least 50% of it through the California managed audit. Not all states, by the way, offer a managed audit. Something that we're starting to see more of are these retail delivery fees. Right now, Colorado is the only one with an active. Minnesota doesn't go into effect until next year, July of 24. In Colorado, this requires a separate registration, and Colorado is very aggressive. Now, when they first came out with this, it was anyone who had Nexus in Colorado. Right now, if your sales are under $500,000, in Colorado, you don't have to worry about this retail delivery fee. But for the larger sellers, this is an extra registration that you have to consider, and we think more and more states are going to go to this. All right, registering for sales tax creates an income tax nexus, and this is not true. However, some states automatically register you for income tax when they're registering you for sales tax, and then it's up for you to determine if you actually need to file a return or not. So, a lot of people say, I'm not registering for sales tax because I don't want to create income tax nexus. Well, registering for sales tax does not create income tax nexus. We do think that income tax is going to be the next big battle out there. And FBA sellers are going to be the first target. California and Pennsylvania already very aggressive going after FBA sellers. It's not going to stop there, though. All e-commerce sellers are going to be the target of states. A couple reasons why. Number one, Massachusetts thinks PL 86-272, which is a protection federal law passed by Congress back in 1959 that protects companies from interstate commerce under certain circumstances. Massachusetts says in light of Wayfair, that's unconstitutional. The Multi-State Tax Commission, they've put out guidance saying that if you used cookies, emails, or chats, they exceed the protections. And if you get a website, you're probably doing that. So in Oregon, gross receipts taxes are not protected by Public Law 86-272. So here are some of the aggressive states. We've talked about that a little bit. What I want to get to are the states that automatically register you for income and franchise tax. And these are 9. This is not an exhaustive list, and it's changing all of the time. If I did this presentation 2 years ago, it would have been 4 states maybe. So it is growing, and over the next 6 to 36 months, I think this is the next big battle for multi-state sellers. All right, so let's talk about the Streamlined sales tax program. I'm not a big fan. I've mentioned that earlier. The biggest beneficiaries of the program are the large software companies. They get paid by the states to offer this program. My motto is, if it sounds too good to be true, it generally is. Software companies are not great when it comes to doing returns. If you're okay with that, then go ahead and use the Streamlined sales tax program. But most people find that software companies are not the best companies to prepare returns. And when you try to switch out, it's like getting jumped out of a gang. I mean, it's really, really tough to get out of the Streamlined sales tax program and get back to a normal registration. So filing problems. You can't file the Washington Business and Occupation Tax through the Streamlined Sales Tax Program. Home rule jurisdictions are a problem. I mean, we have clients coming to us all the time and say, hey, Avalara told me I didn't have to worry about anything if I just went with them under the Streamlined Sales Tax Program. And now I just got a letter from Washington and they say I haven't paid the business and occupation tax in 3 years. Or, we have another client, and these are not isolated incidents. I mean, there's multiple examples of this. In the home rule jurisdictions of Louisiana and Colorado, they had $960,000 of tax collected and not remitted because they were signed up for the Streamlined Sales Tax Program. Avalara was the one collecting all the tax, but they didn't let this company know they weren't remitting the tax. So by the time you had penalties and interest in there, we went in and were able to negotiate VDAs in a lot of the jurisdictions, but they still had to pay about $500,000. So it's big problems with this program. And Ellie, let's get the final polling question done.
Absolutely. And we have another quick little quiz for you here. Little true or false question. Registering for sales tax creates income tax nexus. True or false? Mike, we're going to leave this open as answers are coming in here. Most people are answering false, but let's review it quickly before we close out and answer a couple questions. And then we can, and a quick reminder, you do have to answer these poll questions in order to receive CPE credit. So Mike, why don't I close this out and let's move forward.
And the correct answer is false, and most people have gone ahead and answered with the correct question. Ellie, right now, what I'd like to do is open it up to questions. We have any questions?
We do. Okay, so someone asked, are there any textbooks or resources for independent study that cover sales tax on a basic through advanced level?
Not that I know of. And one of the problems is this changes so quickly. By the time it's printed, it's usually out of date. So there aren't very many courses that are taught in school that talk about sales tax. So most of this is learned by doing. I mean, there are research sources out there that cover some of the basics. Any of your Wolters Kluwer's or Bloomberg or Reuters, they all have general what they call treaties in there. But buying a software like that, research software, is not cheap. We spend probably, I don't know, $15,000, $20,000 a year on all the sources that we have, and that's what we utilize for teaching is internally is excerpts through there.
All right, thanks so much. It doesn't look like we have any other questions. Is there anything else you'd like to touch base on?
Let's look at this right now. I like talking about this. Why now? Why is this so important now? And the reason is, roughly 50 to 60% of states are not, companies are not compliant or fully compliant when it comes to economic nexus. And the states know that, and they're gearing up to track down sellers. A lot of states have already started. They started this process prior to the pandemic. Some states, they put it on hold. When these states are gearing up, okay, they're looking for economic nexus, but they're going to stumble across all types of nexus while looking for this economic nexus. And then during a recession, and if we start seeing the negative impact of a recession, then states are going to need to make up revenue. And historically, they've increased their discovery efforts during or after downturns. So I think we have a perfect storm here. The states are coming because they know 50 to 60% of companies are not actually compliant or fully compliant. And then they need extra revenue. So they're really in a position where they have to amp up their efforts. So, and you might say, well, Mike, why are you talking about Nexus? Well, once they find out that you have Nexus, then they're going to come after you for that past exposure. So you really want to be proactive. You want to figure out what your Nexus footprint of what you sell is taxable. And if so, how do you move forward? Do you just do prospective registrations, historic registrations, voluntary disclosure agreements? Maybe there's an amnesty or two out there, or a managed audit. And with that being said, Ellie, I appreciate everyone's time today. And let us know if any questions come up that you didn't think to ask while we were on the webinar today. Thank you, everyone.